You've tuned into the Tuesday broadcast of Market View. I'm Nancy Lesotole. Welcome to the program. Today, our focus is on the African Development Bank's 2026 African Economic Outlook. The report highlights the need for stronger domestic revenue mobilization, strategic infrastructure investments, and greater economic resilience. As per the report, Eswatini's economy is projected to grow faster than the Southern African regional average, even though it continues to face pressures from SACU revenue dependence, energy imports, and high unemployment, among other factors. But we'll get a sense of these findings in conversation with economist Sanele Sibia. But first, let's get you up to speed with some of the latest in business. In our business news, the Minister for Finance, Honourable Neil Reichenberg, says African countries must continue to demand urgent reforms to the global financial architecture to ensure fairer credit ratings and sustainable debt resolution frameworks for African nations. The Minister was speaking at the African Union Joint 9th session of the Specialized Technical Committee on Finance, Monetary Affairs, Economic Planning and Integration, and the 5th session of the Specialized Technical Committee on Trade, Tourism, Industry and Minerals, held in Côte d'Ivoire last week. The meeting was held under the theme Financing Africa's Industrialization for Sustainable Development.
We cannot speak of industrial transformation while turning a blind eye to the looming fiscal constraints facing our continent. Rising debt service costs continue to swallow vital national budgets, crowding out investments in infrastructure, healthcare, education and industrial development. High global interest rates and unfair risk perceptions have severely restricted Africa's access to affordable international capital markets. The principal challenge is not merely a total absence of capital, but our ability to mobilize, retain, and channel internal resources effectively. Every year, Africa mobilizes over $600 billion in tax revenues, receives over $100 billion in diaspora remittances, and holds substantial assets through the Africa pension funds and institutional investors. Our tax percentage to GDP is too low. But at the same time, members, our problem here is the fact that our continent, we have a large percentage of people working in the lower categories of the wage scales, in the agriculture space and forestry, sugar, those kind of industries. At the same time, we have a certain amount on top and a lower amount in the middle, our teachers, security service in the middle. But where we really are lacking is that strong middle class, like other continents do have, and that is around industrialization. So unless we can solve our industrialization problem, our tax problem remains an issue. At the moment, most of us, some countries get good tax remissions from natural resources. Most of us make our tax from the PAYE and the VAT that we charge, and those come from people working. And so unless we solve these things together, we're going to remain in a closed loop of remaining with low taxes. At the same time, we can get our taxes up to the low 20s, but to move beyond the low 20s without industrializing is going to be very difficult. So these two discussions really happen hand in hand.
The Minister for Natural Resources and Energy shares his remarks.
As the committee responsible for trade, industry and minerals, our message is simple. Financial instruments must directly feed the real economy. Capital must build factories, process resources, move goods, and create jobs. Financing industrialization in Africa remains constrained by high perceived risks, underdeveloped capital markets, and massive infrastructure deficits. Foreign direct investments into Africa dropped to roughly $70 billion in 2025, representing a mere 4 to 5% of global FDI. Meanwhile, Africa's manufacturing value added stands at $351 billion, accounting for less than 2% of global manufacturing output and only 13% of our GDP. This is a sustainable imbalance that we must reverse to realize Agenda 2063.
Part of the meeting's resolutions include mobilizing resources to strengthen Africa's financial architecture, reforming financial systems to improve access to affordable long-term financing, and adopting the Abidjan Declaration as a framework for implementing Agenda 2063 and the Action Plan for Accelerating Industrial Development for Africa and other continental development initiatives. Reporting Nelson Langamandla, some visuals from the African Union.
And that is your business brief. After the break, we'll speak to economist Anela Sevilla. Stay with us.
To all the viewers of Eswatini TV in the kingdom and beyond. Eswatini TV is regulated by the Eswatini Communications Commission through the Broadcasting Code and Broadcasting Guidelines. Under these instruments, the station commits to broadcasting information and news that have been fact-checked, programs and content in respectful language with no elements of hate speech, violence or sexual activity. If you hear any unsuitable content on this channel, you have a right to voice your complaints with the station management. Should you not be satisfied with the response or action taken, you can escalate your matter to the Communications Commission at PO Box 7811 Babani. Call 2406 7000 or send an email to info@esccom.org.za. For more information, visit www.esccom.org.za.
Welcome back, and moving on with the program, the African Development Bank has projected Africa's economic growth at 4.2% this year, according to its latest African Economic Outlook report. Closer to home, the Central Bank of Eswatini, in its latest monetary policy statement, reports that the country's real gross domestic product grew by 6.1% in the first quarter of this year, compared to a revised growth rate of 5.8% in the fourth quarter of last year. But what do these figures really mean for Eswatini? How does our economy compare with the rest of the continent? And more importantly, are ordinary Maswati likely to feel the benefits through more jobs, increased business activity, and improved living standards? To help us understand what is driving this growth, whether it is sustainable, and what it means for the country's economic outlook, we are joined by economist Anela Sevilla, who is in the studio. Mrs. Sevilla, good afternoon. Thank you very much for your time. So the central bank says Eswatini's economy grew by 6.1% in the first quarter of this year, which is actually quite above the AFDB's projection of 4.2%. What factors would you say drove this performance?
Thank you, Nutsile. Good afternoon to you, and also good afternoon to the viewer. So one interesting thing about the kingdom's growth story right now is we have actually snapped from that average of 2.5% year-on-year growth that we've been seeing over the past 3 decades. Since 2021, we've been on the 4-5% level in terms of annual GDP growth. So in terms of our performance for the past 3-4 years, we've been performing well above the region's growth project, above the average growth in the region. So we're one of amongst the fastest growing economies in Africa. And that is largely driven by the fact that we are seeing a lot of infrastructure investments. I mean, we entered into what we call an era of mega projects, where we're seeing a lot of capital infusion into the economy through government expenditures. And then we've also just basically beginning to see, the rebound of the hold of the services sector in Eswatini. So if you look at our growth numbers right now, it is largely driven by movements in the services sector. So that's where we are. And what then that means is, yes, we are performing above the region, and we need to ensure that we're able to get this growth to actually translate into tangible economic benefits and sustainable benefits over the medium term. Because as we are growing through infrastructure-led development, what it means is you have the growth because there are these jobs that have been pumped into the market through these construction phases. But what then happens after the construction phases? Now that is the bigger picture of where we are in the long term after we can't replace this amount of expenditure that we are seeing coming through from this capital expenditure.
You've given us the domestic analysis of things. Paint us the continental picture. If the projection is for the African economy to grow by 4.2% in 2026 with a rebound to 4.4% in 2027, despite global economic uncertainties that we've seen as well, what factors do you think could sustain or support this resilience?
One of the issues that Africa has right now is Africa is a younging population. So over about 50% of the continent's population is actually below the age of 35. So that means we have a youthful population which is coming into the space. And we're also seeing a lot of these infrastructure projects across the region and across the entire continent, where we're looking at most of the countries in the continent taking advantage of the Belt and Road initiatives. So we're seeing a lot of growth that is being driven largely by construction right throughout the continent. And then also another thing that we are seeing is the concerted efforts around Africa to ensure that we are able to reap the demographic dividend as a continent. We are seeing a lot of these investments going into, skilling the youth and making sure that the youth is ready for the job market. And we're also seeing deeper integration within the region. So what that then does is we get a bit insulation, or we get an alternative around access to markets, where if we can't send something abroad, we are seeing the emergence of the Africa Continental Free Trade Area coming into play. And what that then does is we're able to bring a lot of the trade intra-Africa, and that does limit the exposure to those to those international dynamics. And then also what we're seeing is Africa is a rich continent in terms of our natural resources, and we are seeing a lot of that extraction. And if you look at the Congo Belt there in Central Africa, right through there, we have a lot of these rare earth minerals which are being mined. That's your cobalt, which are the minerals that are running industry right now. And we're also seeing emergence of artificial intelligence. We're seeing Kenya doing very well in fintech, and then we're also seeing Congo and the entire region now integrating artificial intelligence into that, and we are seeing that growth being driven by that momentum and the fact that Africa is opening up for business.
The issues at continental level are relevant here at home. You speak about a youthful population that we have seen continues to face a really high unemployment, at the same time are facing a high cost of living and limited business opportunities. Given that, would you say there's a disconnect between growth on paper and the lived realities of the regular person, especially the young people? What would need to happen in order for the GDP growth to translate into benefits or evident improvements in people's lives, especially the under 35-year-olds?
Yeah, thank you. That's a beautiful question, and it's a question every economist is contending with. How do we get the growth to be broad-based? Because right now, if you're looking at growth that is led by infrastructure development, that's short-term growth. And if you look at the level of mechanization that has come into the construction space, what it then does is it creates a situation where even if you could have ideally employed 10,000 people, but you could have one crane do the work of quite a lot of people. So there is also that mechanization that's coming into place. So what we need to do in Africa to make sure that the growth is broad-based. We need to create the jobs. I think the minister just put it clearly there, that what you need to do, that's where the taxes come from people who are working. You need to make sure that you drive the economy in a strategic direction such that you are able to attract these high-paying jobs, because you may argue that there are not jobs and then someone else may argue that there are jobs that the people do not want. So what we need is to make sure that we are growing both the manual type of jobs and then also growing the high-tech space type of growth, the high-paying type of jobs that people would then take up, right? So to do that, you need to make sure that you have the environment and you are investing in the people. It takes a lot of money. You know, for countries like Taiwan to become a giant in the semiconductor scale, there was a lot of investments that were made there in tooling the people and in having the infrastructure to make sure that we are able to come up with that type of space where you're able to assembly these semiconductors there. So that's what Africa needs. We need to grow our people and prepare them for that high-tech space.
Mrs. B, in the report, much of the projected growth is attributed to or linked to investments such as the Bageni Dam, petroleum storage projects, and renewable energy investments, of which, as a country, we have seen just how vulnerable we are to external shocks. It's a matter of acting quite fast, especially in terms of energy infrastructure. How important are these projects in transforming the country's economy just beyond the short-term GDP?
My problem with the way Africa in general structures our construction projects, and it's one of those things that we really do need to sit down and decide upon as a continent and in which direction we are taking. Most of these programs we are talking about are largely funded through bilateral or multilateral financing. And one thing we've noted is when the bilateral finance is being negotiated, you find that we are just a conduit for the money to come and fetch interest. Otherwise, a lot of the construction, the money goes back to the originating country, which is a sad story for Africa. And that is why I've always said we need to go to markets, because once you can go to markets to mobilize your money, you are able to have that freedom in saying, I want to build this energy reserve, for example. But that energy reserve is not going to benefit us in any way if we do not have the skills and capacity to operate it after it has been constructed. So you want to structure the construction arrangement in a way that there is a skills transfer if you can't get the money from the markets. There is a skills transfer and you're making sure that the money stays in the local economy. And I think that's pervasive across Africa, where we are seeing a lot of these loan agreements being signed. Depending on which country has given you the loan, you'd find that the company that has to do that construction will have to come from that country. It is through no fault of any African leader, but I think it's through the lack of our negotiating capabilities and our negotiating skills as Africa. And that is why I always say we need to go to markets, but we need to build the systems that make sure that once we go to the markets to get the money, we are able to come and deliver what we need to deliver, and we deliver it on time. So now that is one of the main issues. For me, it's not about the construction. It's about how do we get that construction to give us long-term and sustained growth, because these are snapshots episode of growth, right? So right now we are in a point where we are worried about the growth story and the growth trajectory of the kingdom, in the sense that we seem to be running out of fiscal space to sustain this momentum going into next year if you look at our debt to GDP ratio. So what we need is these construction projects that we've embarked upon to give us the multiplier effects and produce those sustainable jobs. We need to get commerce to come into Eswatini, attract the FDI to come into Africa, and make sure that the production occurs within the continent. And that requires a comprehensive investor package that is going to somehow make a production in the region and in Africa quite competitive globally. Because if you want FDI, you have to also think around global competitiveness.
You talk financing in the advent of fiscal challenges. Notably, 40% of Eswatini's public revenue comes from SACCO transfers. I think this is a question that I've asked you a couple of times, but I will throw it in again. How risky is this dependence, rather, especially considering that our closest trading partner being South Africa has economic challenges of their own?
It's quite risky, Notsile, in the sense that it does give us a bit of comfort to know that we have SACCO money coming in. But it also gives us this laxity in terms of just sitting and waiting and hoping things will be okay, right? And that's what I call the negative legacy of success, where we need to build on that which we have to expand. We all know that over-dependence on SACCO revenues is not a good thing. And if you look at right now, a simple example, if you look at the wage bill, it is now in the excess of 12 billion, but what we are receiving from SACCO is how much? 11.7 billion, around that figure. So what we have right now is, before we knew that SACCO money was purely for paying the wage bill. But right now, the SACCO money is not enough, right? And imagine what would happen if we were to lose a couple more billions from that money. So that means we are going to have to start sacrificing our education. We'll have to start sacrifice our capital projects. Capital projects are usually the first to go, because most of the other government expenditures are recurring. So capital projects are usually the first to go, and we are going to have to sacrifice those. So now that's a very, it's a very thin ice to be on in terms of when does it crack. Because as we do right now, we are looking at the potential impacts of the fund of funds on our revenue flows. Remember, there is a fund of funds, and we are going to be taking out around 5 billion from that in the next couple of years to capitalize the fund, and that money is going to come from somewhere, and it's going to come from the pool. So we don't know how that is going to work. So as a country, we do need to diversify in terms of our resource mobilization. And if you look at the report, it points out to a domestic revenue gap of around 439 billion, if I'm not mistaken, 439 billion US dollars across the entire continent. And we remember in Eswatini we had a World Bank study that actually said we could improve our revenue mobilization quite significantly without adding new taxes, but just by making sure that we're able to just collect that which is already there and just fastening and tightening the screws there. So we need to ensure that we get to that level of diversity in terms of our revenue streams as a country.
Mr. Spear, thank you very much for your insights on that one. We'll be with you, or back with you shortly. That was economist analyst Spear chiming in on the AFDB's economic outlook report for 2026 that projects a continental growth of 4.2%. After this, we are still with Sibiya, economist analyst Sibiya, just for market insights. Stay tuned.
Those that
are in pain must forget all the problems they have. Because the things of the earth have got no answer. But the answer that we have is all morning. When I'm preaching here, I'm preaching to myself. I receive the Holy Spirit.
I declare a turnaround is coming my way.
Turnaround is coming in my life.
Welcome back. You are still watching Market View, and moving on to our market analysis. In-house economist analyst Spear is still in the studio. Mr. Spear, while you're still with us, so it's a busy week of tech earnings and AI spending is in focus. What do markets make of this AI trade?
Thank you, Notsile. So what we're seeing in terms of that AI space is there's a lot of divergence. Markets are a bit cautious. We've seen quite a lot of billions of dollars being pumped into the AI space, but we're still not yet seeing the profitability that markets would want. Investors are not in there for the promise. Investors want money, not a promise of a future earning, and we've seen that happening quite a lot, and there is that worry around that AI spending. And if you look at the numbers today, you can see that a lot of the semiconductors are not performing very well today because we have a lot of those AI stocks, those tech stocks that are in forecast this week. And I think markets are just not predicting very good earnings. And then you tend to contrast that with the huge amounts that have been spent on that. And then also on the same side, we are seeing, interest rate decisions on the play. We are waiting for the American Fed's Reserve to come out and detail their interest rate policy. Same thing with the UK and the EU and the ECB, and same thing across Japan. And we've seen quite a surprising move in South Africa. And I think markets were kind of expecting an upward adjustment in the interest rates, and we didn't see that. So there's a lot of rebalancing in terms of where markets are. So right now, in terms of the markets, the Nasdaq Composite Index, if you look at it, you can see that it is somehow losing a bit of momentum in today's trade, losing some 43 points. Now, that is largely driven by the fact that we are seeing a lot of some pessimism around the performance of the AI stocks. But the Standard & Poor's Index is up some 0.2 percentage points in today's trade, and the Dow Jones Industrial Average has gained 262 points in today's trade, which is being supported by that pause in the war in the Middle East. And then coming into the European markets, Europe is relatively insulated when you look at the number of big tech companies and the tech giants that are listed in Europe. We don't have a lot of those, so we're seeing Europe just really enjoying and floating with the decline in the price of Brent crude oil. It's down to the $84 per barrel in today's trade. So London is back on the 10,800 mark. It was supported by defense spending, and Germany again is up 90 points in response to that drop in the price of fuel. And then France is actually heading for all-time highs, up 33 points in today's trade. So Europe really is eating this in. And in London we have a new prime minister, so that in itself is also playing into where markets are going in terms of waiting for policy decisions. So we're expecting a fiscal policy decision and direction through to come from number 10 Downing Street, and then we're expecting the Bank of England to also give us a policy direction in terms of monetary policy. So now this is in inflation fears are somewhat supporting a rather cautionary stance from the central banks across the globe. Coming into Asia, so Asia, that's where we're seeing the carnage of the AI stocks coming into play. If you're looking at Japan, Japan is back on that 62,000 mark. That's largely because we are seeing those tech stocks in forecast there. The Hong Kong is up 103 points, just benefiting off of those windfalls. And then the Shanghai Composite Index is still on 3,800. So you can see the tech space coming into play, and then also the fragilities within Hong Kong and the mainland there. And then coming into South Africa again is just on that flat line at 109 in terms of all share index today, and largely driven by the fact that we've seen the likes of Impala Platinum just pausing a bit on their mining, and then also we're seeing a weakening of the rand and in today's markets, and that tends to support capital flight. In Eswatini, we have not seen any changes in markets. And in terms of the commodities, gold continues, gold has actually just lost a bit, given the ceasefire and the likelihood of interest rate hikes, while the price of Brent crude oil is down on that $84 per barrel mark. The Lilangeni is weakening across the globe today, not just given those geopolitical fragilities and the performance of the South African economy. Thank you, Notsele.
Thank you very much, Mr. Spear. That was economist Sanile Sibia chiming in today's markets. Otherwise, this has been the Tuesday edition of Market Review. From myself and the team, thank you so much for your company. Let's meet again on the next broadcast. Bye-bye.